Welcome students. So now in the next part of discussion, we will discuss and learn about the financing of the projects or the different means of financing of the projects. And in that process, in the process of financing of the projects, venture capital and private equity play a very important role, very pivotal role. And normally all the say new investment proposals, especially when they are being launched by the new entrepreneurs or maybe as a startup or as a new venture. So there for supporting those ventures or those projects or those maybe enterprises, venture capital and private equity plays a very pivotal role. So we are going to discuss the role of this venture capital and private equity in detail as a very important source of financing or means of financing the new investment proposals or the new projects. So as far as the financing of the projects of existing companies is concerned, there are a number of other sources available, as we have talked sometime in the past, that we can go for the equity, we can go for the debt, or we can go for the maybe diverting the retained earnings from the existing firm to the new project. So those traditional or conventional sources of the funds are available for the projects which are largely maybe expansion, diversification or growth projects by the existing firms. But as far as the new say projects are concerned, maybe the new ventures by the say new set of entrepreneurs or maybe the young graduates from say engineering colleges or management colleges, when they want to set up the projects or they want to set up the ventures as startups. So which source of funding is going to play a very important role, that we are going to talk in detail. That in case of the existing firms, for example, when we talk about the equity capital, so largely major part of the funds come from the existing firm as an investor, and they from their reserve and surpluses subscribe to the shareholding of the newly coming up project or a newly coming up their company or subsidiary, and part of the funds they borrow from the market. So that way they form the capital structure, and because they are existing firms, they are already into the business, they are already presenting in the market. So maybe they are already existing in the market, they are already present in the market. So for them, raising the funds is not an issue. They can easily raise the funds, and normally they decide to go for the expansion, diversification and growth projects when they have the sufficient funds in their kitty. So we normally keep some funds from the profit every year, profit of the existing firm every year. We divert some part of the funds to the reserves, and the reserves which are called as the free reserves, not specific reserves. We create two kind of the reserves, free and specific reserves. So the free reserves are used for maybe making investment into the stocks of other companies if they are not required within the company. So they are called as a retained earnings, and retained earnings, when they are not required in the existing business, they have to be utilized into the new business or a new venture, and the existing firm may become the major shareholder or the promoter of the new venture. So for them there is no issue at all, and largely they also invest the funds in the form of the equity, that may be the retained earnings, or maybe that's called as internal equity, or maybe by resorting to the external equity if they are going to set up the venture as a public limited company. So they have the access to the stock market also, to the financial markets also. So they can raise the funds by way of equity, maybe internal as well as the external, and they bring some amount of the funds in the form of debt also, but they normally keep the component of the debt very low, proportion of the debt very low, because of the negative properties associated to the debt. So they know it very well that maybe debt is cheaper than equity, but it brings a lot of negatives into the firm, and to avoid all those negativities or the distress kind of the things in the firm, they try to resort not to go for the debt and largely fund the ventures with the help of equity, maybe internal as well as external. Even in the existing firms also, as I told you in the some past lectures, that if you pick up the balance sheets of some best managed companies or the well managed companies, I named a few companies like you call it as the say Grasim Industry, Jindal, Tatas, or maybe any other good company you name it as, or maybe a good Tata Group company. So amount of the debt would be very less, found to be very less in their capital structure, because they know it very well that bringing more amount of the funds by way of the debt brings more amount of the distress in the firm. It leads to raising the fixed liability on the overall financial structure of the firm, which has to be serviced in any case when there are the whether there are the profits or no profits. So they avoid that, and At the same time, maybe they want to preserve the borrowing capacity for future, because if there is any say future financial requirement for the expansion of the existing or the new projects, and funds are, for example, not available from the internal equity or from the reserves, and they don't want to resort to the external equity, so they can resort to the debt. Then normally in the packing order theory also we have been asked to, there is a theory, packing order theory, in the financial management or corporate finance, which suggests that normally for say setting up the ventures, especially by the existing firms, they should resort to the sources of the funding in order that first of all they should have the funds from the retained earnings, internal equity or internal sources of the funds. After exhausting it fully, they can go for the debt funding, and external equity through FPO or maybe through other means should come as the third resort, or maybe as the third source of the funding. So, first is the retained earnings, second is the debt, and third is the external equity. So, when retained earnings are not sufficient, only then they can raise the funds from debt or by way of debt, and resorting to equity is their third option, which they normally avoid. So, that is for the existing firms. But here the major challenge comes, as far as the project finance is concerned, the major challenge comes to the new entrepreneurs or the budding entrepreneurs who want to, after graduating from the say technology institutes or maybe from the management institutes, when they aspire to set up their own ventures as startups. So, they face this challenge of raising the fund from different sources, and there comes the need for understanding very clearly the venture capital funds and the private equity funds. So, VC funds, venture capital funds, maybe when we talk about that, who are the VC investors and who give the VC funds. So, for that purpose, we will say here that VC funds may be described as pool of capital constituted for investing in relatively high risk opportunities in anticipation of potentially high risk adjusted rate of return. So, when maybe you call it as the some funds or some high net worth individuals whom we call it as the angel investors also, they pool their funds into a venture or maybe a fund which is called as a VC fund or a venture capital fund, which is managed by the team of a professionals. So, people who have the surplus funds or who are angel investors or who are say intending to invest their funds into the relatively risky projects in the wake of looking for the higher rate of return or the high risk adjusted rate of returns. So, they normally say create a fund, means jointly they pool the funds, and they create a fund which is called as a venture capital fund, which is professionally managed by the team of external managers or a professional managers on behalf of the investors who are going to create their pool of capital. And finally, they are going to invest this capital, maybe the management team is going to invest those funds into the potentially maybe the risky investment opportunities, but they are also generating the higher rates of the return also. So, it is basically a pool of the capital which is given or which is created by the people who have the surplus funds in the high amount and who want to invest them into the say relatively riskier investment opportunities, but as a result of that they expect the high rate of return also. And other thing is that VC funds are usually committed for extended period of time ranging from 7 to 12 years. So, they are making the funds available. Venture capital fund, when any fund is created by any group of the people or any group of the investors and it is professionally managed by the team of management. So, they provide the funds to those identified opportunities or identified projects for a period of 7 to 12 years, and after this period they take an exit from that venture and then they look for a new venture to invest their funds in. And the next thing is that most VC funds are not listed in the stock exchanges, not listed anywhere in the stock exchanges, and they do not have any secondary market also. So, you understand that this brings the amount of risk or element of the risk which is very high, because when there is no secondary market available, right? When these funds are not listed in the stock exchanges and when there is no secondary market available, so in that case it means once you make investment in any venture, your funds are blocked till the time they are allowed to maybe taken out or you take an exit route, means at an appropriate period. You cannot sell it in the secondary market. So, because of the illiquid nature of this kind of the investments, They means entail a high amount of the risk, because once you make investment, after making careful analysis, you have to stay with the venture till the time you are able to take your money with the appreciation. So because of not being any exit route available, normally through stock exchange or the through secondary market, so this means increases the riskiness of the investment. But these funds and these investors are prepared to make the investments. That's why they choose to make investment into the ventures who are little riskier, but they are earning a higher rate of return. And these investors, that's why they're called as the venture funds or the venture investors. Venture capital itself, the other name of the venture capital is basically the risk capital, right? This is the other name of the venture capital, the risk capital. So when people want to take the risk and they want to make their investment into a venture which is little riskier as compared to the other options available, so certainly the rate of return would also be higher, because risk and return go hand in hand. Next thing is, VC funds are usually independent in the sense that they do not represent or subserve the strategic interest of any of the investors in these funds. So all the investors are equally responsible, they are equally contributing the funds, and the management team who is managing the funds on behalf of the investors, they equally serve all the investors. So they are not going to serve the strategic interest of any specific investor in that fund. Means all the investors are equally important for the management team, and finally they are managing the fund created as a pool of capital by these investors, and they are identifying the opportunities, making investment, and then means ensuring that a high rate of return is given to the investors who have created this pool of the funds. So the team of management take a annual fixed fees for managing the fund, and normally it is around 2.5% of the capital under management. The size of the fund they manage, 2.5% of that, which is a very high amount, you can understand, they take as the management fees, or the managers, you can call it as a reward. And apart from that, in case of the any kind of the capital gain in the capital invested by them into the different ventures, they have a share into the capital gain also. So they are called as the performance incentives, that apart from 2.5% of the annual fixed fees, they get some performance incentives also, but those incentives are given to the management team in case of any appreciation in the capital invested into these riskier ventures. What is a VC investment? This is the next important question. What a venture capital investment? So we can simply say, it's very clearly written here, that the popular impression that the VC is synonymous with the financing of technology centric or innovative and hitherto untried business ideas, right? This is a popular impression that VC is synonymous, or maybe they are normally making investment into the technocentric areas or technocentric businesses, or the businesses which are innovative, or hitherto they are untried business ideas. It means only technology centric, or they should be innovative, and they are not investing the funds into the areas which are not innovative, or they are not technology centric. So this is the popular impression, that VC is synonymous with financing of the technology centric businesses or innovative and hitherto untried business ideas, but it is not the case. In reality, VC is a broader and much more flexible form of financing, right? It's a broader and much more flexible form of financing, and it's not only that your business has to be technology centric or it has to be really innovative. In the routine kind of the businesses also, they make investment provided the return expected from the business is high. For them to invest in a business must have exceptional growth prospects. This is a very important requirement. The business must have the exceptional growth prospects, a sustainable competitive advantage. A sustainable competitive advantage that helps to maintain the growth in sales and profitability, which could potentially result in the superior returns to the investors. So their objective is nothing but only to get the superior returns. So whatsoever the business it could be, whether it is technology centric, which is innovative, it's non-innovative, that's not the case. Sometimes they are maybe supporting the retailing maybe businesses also. Sometimes they are supporting the, or many a time they are supporting the e-commerce activities also, which are routine kind of the activities. Means the retailing business is not any innovative business. It's not even technology centric. Even e-commerce activities, the distribution activities, e-commerce activities are not very innovative. Everybody knows and everybody can do that. Only you need to have the say supply chain network, and you should have the basic idea about how to move into this kind of the business. So neither they are technology centric nor they are very innovative, but because they are giving the higher rate of return, or they are maybe producing the higher rate of return, superior returns. So that is the major requirement, that if it is a riskier business but the returns are superior, even in that case the VCs will invest. But if the element of the risk is low but the returns are superior or returns are very good, in that case also the VC investment is available. So it's a misnomer, or you call it as a myth, that you have to be technology centric, or you have to be innovative, or you have to have a different idea which is never tried in the market in which we want to operate. That is not the case. It can be a traditional business also, it can be a maybe conventional business also, and whatever the amount of risk associated to that, that is one thing, but the rate of return expected from that business should be relatively high. If the good return you are going to give back to these VC funds or VC investors, they are ready to make investment. So they will listen to your business proposal, business plan, and then finally if they find that yes, whatever the element of risk is involved, if the return available from the business is relatively better or higher, they would agree to make investment, and they will come forward for investing the funds into that kind of the businesses also. So VC investment usually involve what it involves? Business with high growth potential in terms of the sales and profitability. This is the first prerequisite, or you call it as the first requirement, that their sales and profitabilities must be higher. Naturally, if you are having the market, you are able to sell in the market, so the profitability will also be higher. And if the sales and profitabilities are higher, you would be able to give the better return to the investors. Next thing is, investment horizon is from 2 to 10 years. Depending upon the investment requirement of the venture, riskiness of the venture, capabilities of the team of the management who is managing that venture, maybe the entrepreneurs or promoters. So the investment horizon can be 2 to 10 years. Sometimes it can be a mutual agreement that maybe initially the entrepreneurs get the support from the venture funds, but very quickly they cross that say minimum hurdle level of the break even point, or maybe that initial hardships or difficulties, and they start earning the profits, and their growth becomes exponential, and then they start doing very well in the market. So they can mutually ask the venture funds that to take an exit route, and they can replace the venture funds with the traditional funds from the financial institutions or by way of the private equity, where the main objective remains is to reduce the cost of finance or the financial cost for the venture, because venture funds are very expensive. So because the project has already passed through the maybe the hurdle point, and it has now means they started moving on the growth path, profitability is there, growth is there, so they can mutually ask the say venture investors that now you take an exit route, and we want to replace your funds with the conventional, maybe by way of debt or equity, private equity, and we want to reduce the financial cost. So that is also agreeable. So normal time horizon is 2 to 10 years. Yes, the risk involved normally is very high, but it's not true all the times, right? It can be high, it cannot be high. For example, when you talk about the retailing business, and in a country like India, even you talk about the e-commerce business, in a country like India where the demand for the consumer products is very high, whether they are maybe eatables or maybe they are the just anything relating to the food, shelter or clothing. These are the necessities of life. If the demand means, because we are 1.5 billion people in this country, so demand for the necessities is there, that is the food, shelter and clothing, sometimes for the comforts also. So normally we are going to be successful if we are honest to our business and our approach is effective, but element of the risk is relatively higher, so they look for that kind of the venture, because if the risk element is higher, so they can expect the higher rate of return. And next thing is the equity or quasi-equity financing instruments. Normally they provide the funds through the equity or the quasi-equity way of financing. So they participate. Normally they don't give the debt. Venture funds become the partner in the progress, and they bring the funds or they invest the funds in the form of an equity, because that way only they are going to take the high amount of the risk. When you become the equity shareholder, maybe not professional equity shareholder like in a company listed in the stock market, but in a startup also, when you contribute into the equity, the internal funds of the company, or maybe in the form of the equity of that venture, so you become the kind of an owner for a limited period of time. And when you become the owner of that business, so profit and loss is all yours. You cannot expect any return when there is a loss, and you can expect only the returns when there is a profit. So it may be equity or the quasi equity financing. So quasi equity financing are basically mezzanine funds or maybe the junior debt kind of the funds. Junior debt means which is not a proper debt, where maybe it's not the priority to be given in case of any repayments back to the debt providers. In the normal debt, in the senior debt, or into the normal debt, in the case of the normal debt in the market, you have to pay a regular rate of interest, or maybe at a rate of interest you have to pay the regular interest to them, to the lenders, and maybe on the due date you have to redeem the bonds, you have to return the principal back also. So those kind of the fixed liabilities are always there if you raise the funds from the appropriate debt or from the senior debt. But when you raise the funds by way of equity or by way of the quasi equity, so in case of the equity, because the investor is the owner, so the business is under no obligation to provide any returns to the equity investors. And in case of the quasi equity, if it is a mezzanine fund or if it is a junior debt kind of the things, even then they don't have any right to ask for the regular interest payments or maybe redemption of that debt on the due date. It is little having a priority over the pure equity. Mezzanine funds or the junior debt is having a priority over the equity, but not at all a kind of a fixed liability like in case of the proper debt or a senior debt. So normally the funds are provided in the form of equity or quasi equity, where the growth is only shared by the investors, but in case of any kind of the losses, they have to be equally responsible, and they cannot ask for any kind of the returns or funds. So by making this investment in the form of equity or quasi equity by the venture funds, if the business grows, then their funds will also grow, and at the time of exit they will take their money with appreciation, their investment with appreciation out, and they will take an exit route. They are not provided any regular dividends. In case of the venture funds or even in case of the private equity also, they are not provided any regular dividends or the share in the profit. That is all reinvested back into the business, and this business is allowed to grow. But when this venture capital funds, when they take an exit route, they are paid back their share of the investment along with the appreciation, along with the capital gains, and that is the reward of their investment into the venture. But for example, at the time of exit, their investment has gone down because the business has incurred the losses or business has to be closed down. So they are equally responsible for sharing that risk, and they cannot ask any kind of the return that you return my money, maybe the principal or with some return or appreciation. That is not the case. So at the time of exit route, the venture fund providers are returned the share of their investment back with appreciation. Till the exit route, they don't ask for any kind of returns, and they practically participate into the day-to-day affairs of the business for the management of the business, and they make sure that whatever the investment they have made is, that investment is going to grow, and at the time of exit from the business, go out with a sizable share of the investment, that is their principal amount plus appreciations on that. And active investor involvement in the future after funding. So it means when the venture funds are giving the funds, so they are equally involved into the management of the business, and they make sure that their funds are safe and growing, so that at the time of exit route they are going to take the sufficient funds back in the form of appreciation. What makes a VC investment different? So VC investment is different because of these two important factors. Number one is the high uncertainty level, and then next one is the information disclosure. So because the risk involved into these kind of the ventures is very high because of the technological risk, product market risk, management risk, and liquidity risk. So that is the one reason that they are high risk investments, and as a result of that the return expected is also higher. Second thing is because they are not listed companies. The new ventures or startups are not listed companies, so there is no standard source of information about that venture. Whatever that information is provided by the entrepreneurs or by the group of the promoters, maybe to the investors by way of the presentations being given or by way of all the estimates they have made about the market and demand analysis, technical analysis, so on and so forth. Only that information is available to them. There is no other source of the information. So assessing about the riskiness of the business in the absence of good information, effective information, is sometimes very difficult. So because of the high risk or because of the high uncertainty and the element of the risk is higher, and because of the lack of proper information associated to the venture, means the availability of that information associated to the venture, this becomes a riskier investment. But if everything goes well, where they make investment, and if everything goes well, so they can get the good returns from these investments. So these risk, technology, product management, and liquidity risk is another important typical risk, because there is no secondary market for the VC funds to liquidate their investment into any kind of ventures. Once any investment is made, it has to stay till the time that exit time has come, and only at the time of exit, which is mutually agreed by the investor as well as the promoters or the entrepreneurs, till that time they have to wait for liquidation of their investment, and finally at the time of exit they will be given back their share, the principal amount as well as the appreciations on that. Then the VC investment appraisal process and management. This is very important, and this is a very interesting part also. Assessment of the business and management. Right. So they make an assessment of certain things. Number one is assessment of business and management. They go for the, say, valuation of the VC transactions. That's very important second consideration. Then deal structuring, what kind of the deal is there, or they are going to structure it. Investor-investee relationship, they go for while making the appraisal about that particular investment they are going to make, and about the management also, who is going to manage the venture, and post-financing relationship, that is again very important, and exiting from the investment. So these are the important steps involved into the investment appraisal process, and maybe the management of the venture, if the funds are provided or funds are invested by the investors into that particular venture. So first of all, the assessment of the business and management. So first of all, they want to know what kind of the business this venture is involved or is going to be involved with, and who are going to be the management team, what is their background, what is their qualification, what are their technical skills, and how they are conversant with this kind of the business. So they want to make sure about that. That is the management team, business strategy and exit focus. That means after making investment, when they have to take an exit from the venture, how it is going to be possible and how much appreciation they can expect. That also depends upon the type of the business and the management team who is going to manage that. Valuation of the VC transactions, right? How this VC transaction is going to come out or maybe going to produce the results. So that depends upon the economy's outlook, capital market conditions, industry factors, deal, demand and supply of the capital. So these are some of the factors, right? So they all have to take into consideration that how the economy behaving, whether it is suitable for this kind of the businesses or this kind of the processes, how the capital market is currently behaving, and how the overall maybe the conditions of the capital market are there, industry in which this venture is going to be the part of, how the conditions of that industry are, and the deal which they are going to make, what that deal is going to provide them, what kind of the returns, what kind of the safety and sustainability, and what is the state of demand and supply of the capital. If the demand for the capital is higher, so the VC investors make a very strict appraisal, and they know about the business and management very critically. But if the demand is lesser, then it can be easier also, because they also have to look for the avenues of investment. Same is the case from the supply side also. If the supply of the capital is very easily available, if the sufficient supply of the capital is there, so appraisal process is poor or maybe lesser, not very stringent. But in case of the, say you call it as in case of the lack of supply of the capital, so the appraisal process would be very stringent. For example, you see when recently when the RBI has reduced the repo rate, so now the sufficient funds they have, means 2 times they have reduced the repo rate after taking off of the new governor of RBI, Mr. Sanjay Malhotra. One time they reduced it by 0.25 basis points, and one time they reduced it by 0.5 basis point. So now total reduction in the repo rate has come down by 0.75 points, and as a result of that, liquidity in the market or in the banking sector has gone up. And if you see recently, because of the increased liquidity, interest rate on the deposits have gone down, seriously gone down. So, and as a result of that, loans will become also cheaper. So because the money supply has increased in the market, so the interest rate for the investors have gone down, so they cannot expect the better returns. Same is the case here. If the supply of the capital increases in the market, so the rate of return expected by the venture funds is also not very high, and their even appraisal process is also not very stringent. And if the supply of the money reduces in the market, so they become very careful, appraisal process becomes very stringent, and they start asking for the, or maybe demanding the better rate of returns. And deal structuring, say mostly equity based, is going to be that what is going to be the deal structuring. So normally they do not provide any funds by way of debt, because if they are giving a debt, so they are not going to take any kind of the risk in the venture, because debt is normally for the investor, debt is normally risk free. So they provide the funds in the form of equity, they become the partner in the progress, and they bear all kind of the, say, ups and downs, or maybe goods and bads, and they enjoy the growth also, and they bear the, maybe the downward trend of the venture also, and finally they are the complete and true partners in the progress. Investor-investee relationship is another important consideration they look at, that who is going to be the investee's team, the borrowing team, or maybe the fund, who is going to be that, maybe the venture, the business team is who is going to manage it, and if they make investment into that business, how their relationship with the management team, or maybe with the owners, are going to be. Normally in the small businesses, the owners and management remains the same. In the startups, or maybe into the, say, sole proprietor or partnership kind of firms, the businesses, the ownership and the management remains the same. So investor has to see carefully while appraising the, say, potential investment, that how their relations are going to be with the firm, or maybe with the people or the owners of the firm when they are going to make the investment, because to a larger extent that also makes a big difference. And post financing relationships are also equally important. So if the team is who is managing that venture, the startup or the project, if they are effective, they are careful, capable, so they are means professional in managing the business, so they want to have a better relationship with the investor, because they don't want to spoil the relationship, and they want to maintain very good relationship, so that overall a good news goes out of the business in the market, and everybody is ready to support them. Maybe not in this case, but in the next round of the raising of the capital also, if the relationship is good, then it's going to be very helpful to the venture owners, and it's really a good situation for the investors also, to the venture fund or to the venture investors also. And finally, they want to make sure that when they have to take an exit from the venture, then what important things are going to be taken into account, and how they would be exiting from the venture, after how many years they would be exiting from the venture, and at the time of exit, what return or maybe the appreciation in their capital they can expect. So all these things they take into consideration, they bear in the mind, and finally they take a decision on the basis of that. Next thing is the valuation of a VC transaction. So for the valuation of a VC transaction, the most commonly used method of valuation used by the VC funds involves the following steps. First of all, identify the amount of capital to be invested. How much amount is being demanded by the investee company or that investee venture, and how much they are going to invest into the venture. Next thing, target rate of return is what? At what rate they are expecting the return on their investment, though it will be paid at the time of exit in the form of capital gains or appreciation to the capital. Still, they have to pre-work on the rate of return expected from that investment. Multiple of the original investment. Estimate the multiple of original investment that will fetch the required rate of return over the anticipated holding period. So how many times their investment will become when they take an exit route. So that is the multiple of the original investment is going to be when they are going to take an exit route, because their ultimate purpose is the growth of their investment. They are going to take the huge amount of the risk. So when they are going to take the huge amount of the risk, they are supporting the venture when no other source is coming forward, or they are ready to support the venture. So certainly they expect a very good rate of return, because they are going to take the huge amount of the risk. And project the market value of the firm based on the performance. Right, projected value of the firm based on the performance projected during the proposed years of the exit. So what would be the projected market value of the firm when they will take an exit? This would be a multiple of an appropriate metric like EBITDA. So they use normally EBITDA, that as a multiple of EBITDA, what would be the projected market value of the firm at the time when they take an exit, because if the firm is growing at a faster pace and their EBITDA is good, so certainly they can expect the better returns, and if the firm is not growing as per the expectations, so in that case their return will also be affected. Last is estimate the percentage of the projected value. Estimate the percentage of projected value that the investor needs to claim in order to achieve his return objectives, right? Percentage of the projected value. It means the total value of the firm and what part of that will be paid back to the venture investors when he takes an exit route. For example, the total value becomes 100%, maybe, right? Or maybe this becomes, the firm is becoming of, say you call it as the 1 million, right? Means initially they started with the say 100,000. Initially the firm was started with the 100,000, and at the time of exit that firm has become of the 10 lakhs or the 1 million. So in that case, out of this 10 lakh, what proportion should be taken back by the venture fund? If they say that we should be returned back, for example, 3 lakh rupees, so it means 30% of the projected value they are going to take back, and this will mutually depend upon both the sides, the investor and investee. If they have agreed that you will be given a sizable share of the business at the time of the exit, so they have to pay it, and that is their objective also, that they are contributing in projecting the business, growing the business, so they expect a good return. And after this paying of the 3 lakh rupees to the venture fund, maybe as a return of their investment after appreciation, so this 3 lakh rupees has to be replaced by the business owners by other sources, maybe institutional finance or external equity, or maybe by way of, say, more investment from the promoter's side or the promoter's pocket. This all has to be, because ultimately the business has grown up to 1 million rupees and it needs to be sustained at that level. So you have to have in any case 10 lakh rupees to run the show. So if the venture fund has taken an exit route, so you have to look for the alternative funds, sources of the funds, and again keep the level of the firm, that is 10 lakh rupees. So means everything they want to make sure that appreciation in their investment should be good, the return on the investment should be good, and finally when they go out, they are getting the good rate of return on their total investment. Then finally we will talk about is the stages of the venture capital financing. So when we are talking about the stages of venture capital financing, so there are many studies which have been conducted, and when you talk about these stages, so we can say here that different stages are there. So first stage is the seed stage, then is the startup stage, then different rounds, first round, second round, third round, and fourth round, right? So at the seed stage, normally the venture funds come into existence. They support the business. They have to support the business for the development of the product, test marketing, build a foundational team for all these kind of activities, because initially the team of promoters or team of the entrepreneurs, they need support, they need guidance also, they need funds also, and they only know that our idea is going to work very well, but implementing that idea and converting that into a business, developing a product and going for the test market and everything, you need the seed money. So for example, the total investment requirement at that stage is the 1 million, right? And the initial promoters, they have in their pocket, for example, if they have the 5 lakh, so remaining 5 lakh has to come from some source. So that remaining 5 lakh rupees, that is the 50% of the investment, has to come from the venture capital, provided the idea is suitable. When this team of the entrepreneurs, when they will go to the venture funds, make a presentation with them that you come forward, join hands with us, and if you help us developing the product or testing the market or maybe building the foundational team, certainly the business is going to grow at a very faster rate and we are going to give you the very good return. So in that case, the seed money is required. Venture funds, if they are convinced with the presentation given by the group of entrepreneurs, then they decide to make investment. And once they join hands in the business, so sufficient seed money comes in the business, technical say support comes in the business, and finally in the form of the seed money, the business takes the shape. With the help of the seed money, business takes the shape, and finally they start working on it, they develop the prototype of it, they test the market, and finally they start maybe the commercial production. And once that commercial production starts and product goes to the market, and for example it becomes a success and people accept that product or the service and business starts growing, so you need the funds, because at that time means the second stage comes, and that second stage is the stage of startup. It becomes now a proper startup because it's already into existence, it has crossed the seed stage, venture fund is already supporting it. So now after becoming a startup, you need more funds for the expansion and growth. So either the venture funds, existing venture investor, they give more money, or some new maybe set of the venture investors are looked for, and then they also join hand, because now the business has proven its mettle, it's growing, and we need the funds for the say growth also. So from seed stage it goes to startup stage, and when it starts further growing, so we go to the further stages, first round, second round, third round, and fourth round, and finally we keep on depending upon these venture funds till the time the business becomes self sustaining. Once it becomes a self-sustaining, even maybe after the 10 years of its existence, then at that time when it becomes a self-sustaining, it has proven its mettle in the market, the product is well established in the market, or the service is well established in the market is growing, people have accepted the product or service. So at that time finally, because this funds coming from venture funds are very expensive, so mutually the venture funds or venture investors as well as the management team of the enterprise, they mutually decide that now the venture fund should take an exit route. They have sufficiently supported the business has become self sustaining now. So at that time, say they are paid back their investment with sufficient appreciation, and their share is replaced with the say the sources of funds from the other conventional or traditional sources, like institutional finance, or maybe as a called as a private equity or something like that. So ultimate purpose is replacing the high cost of funds with the low cost funds, and managing the financial structure of the firm and the overall cost of the funds. So these are the different stages of say venture capital financing, which start with the seed funding and go up to the different rounds. And once the business has become self sustaining, so venture funds take an exit route, and their part of the investment is replaced with the traditional or maybe the conventional sources of the funding, to reduce the cost of the funds or the cost of the financing. So for the moment we will stop here, and the remaining discussion with regard to the venture capital or private equity, or maybe these two as important source of funding, remaining aspects concerning all the maybe say aspects of the venture capital and private equity, we will discuss in the next class. Till then, thank you very much.